today's video, I'm revealing the exact monthly dividend number that lets you quit work forever and the 3 yield traps that can cut that income in half and force you back to job hunting at 75. You see, you miss the math and one bad market year can drain almost 6 figures from your portfolio. You nail it and your dividends pay every bill for life. I'm Johnathan Rankin, a retirement advisor for nearly 20 years, and the big question I hear almost every week is, can I really retire on dividends alone? So let's find out. You see, retiring on dividends means living off the cash that your portfolio throws off, so no share selling required. So your checks might come from stalwarts like Johnson & Johnson, dividend ETFs, or REITs. See, 2 big perks are that you're not trying to time the market to raise cash, and the income keeps showing up even during volatility. On paper, it sounds perfect, yet half the retirees that I meet vastly overestimate what dividends themselves can cover. But the real question is whether or not this is realistic. So let's run some numbers and find out. So let's say that you need $40,000 a year. That's $3,333 a month. And depending on the yield, that's going to determine how much money you need. So at a 3% yield, you need $1.3 million. At a 4% yield, you need $1 million, and at a 5% yield, you need $800,000. You see, the math works until the risks show up. See, higher yields often mean higher danger, and in 60 seconds, I'll share the single metric that flagged AT&T's 2022 cut 2 years early and how you can run that same test on any stock in under 30 seconds. See, the key isn't the yield, it's the sustainability. And that's why every dividend plan needs a 3-step dividend reality check. Now, before I move on, it's important to understand how one bad yield assumption could impact hundreds of thousands of dollars in lifetime income over your retirement. So click the link in the description below and you can actually book a call with me directly. I'll analyze your specific situation and show you the exact steps that you need to take to fully optimize your retirement plan as a whole. Now, let's break down the 3-step dividend reality check. Step 1 is you got to calculate the gap. This means asking yourself, what does my lifestyle actually cost once the paychecks stop? So you start by subtracting every dependable income stream that you'll receive. So think Social Security, a small pension, maybe a rental check, from the amount that you plan to spend each year. And the leftover figure is the true dividend bill that your portfolio must pay on schedule. And if your household budget lands at $90,000 and Social Security is going to cover $50,000, then the real gap is $40,000. That number, not a vague hope of living off dividends, is the one that can decide whether or not you can walk away from work. Fixing the target this way keeps you from chasing unnecessary yield or worse, declaring victory too soon. See, in practice, most retirees find that their first 5 years of spending is higher than they had guessed because of things like travel, home projects, grandkid adventures. So build the target around the lifestyle that you want, not the one that you think you can afford. And step number 2 is stress test every payer. You got to ask yourself, is this dividend sturdy enough to survive a recession? Now, with the income gap defined, you want to shift the spotlight to the stocks and the funds that you're counting on. And the quickest X-ray is the payout ratio. So this is where you take the dividends divided by earnings. Under 60%, and the company has breathing room to reinvest, handle downturns, and still raise the check next year possibly. Cross 80%, and that breathing room turns into a tighter collar. One earnings miss, and management has to choose between cutting the payout or piling on debt. Anything above 100% already is running on fumes, and cash is leaving faster than it's coming in. Now, a second lens is the free cash flow trend. So the question is, are real dollars rising year after year or shrinking while headline earnings look fine? See, a decade of steady or growing cash flow, especially through stress years like 2008 and 2020, tells you that the business can keep paying when the economy buckles. And finally, look for a dividend growth streak. That's a company that has raised its payouts through 2 recessions because they're sending the message that we fund this check through operations, not through wishful thinking. And if any holdings fail these tests, then swap it out before it fails you. And this is where that red zone check that I mentioned earlier comes into play. Pull up any stock on a free site like Macro Trends or Seeking Alpha and note 2 figures: payout ratio based on earnings per share and the payout ratio based on free cash flow. If the first number is above 80% and the second number is over 100%, then the company is mailing out more cash than they reliably earn. Leave both those ratios in that danger zone for a full year, and a dividend cut shifts from a maybe to an almost certain. And this is exactly what AT&T's numbers were signaling in 2020, 2 years before the reduction hit. See, earnings can be massaged, but free cash flow can't, which makes this 80-100 threshold a simple, dependable warning siren. Any stock that blows past it belongs on probation, not in an income first portfolio. And now the third and final step in the dividend reality check is setting 3 guardrails. See, the first guardrail is taxes. You want to treat every dividend like a paycheck and decide which pocket it belongs in before it arrives. See, qualified dividends from most large US companies are already tax favored. so they can sit comfortably in any regular brokerage account and be taxed at long-term cap gains rates at either 0, 15%, or 20% depending on your income. On the other side, you have real estate investment trusts or REITs, and those distributions or covered call distributions or ETF payouts and many foreign stock dividends that are taxed at your full ordinary income rate. Those are best tucked into either Roth or traditional IRAs where the government can't nibble at them each year. So it's important to plan your brackets a decade at a time. In low income years, perhaps the gap between leaving work and taking Social Security, convert some traditional IRA dollars to Roth so that future dividends land tax free. If you live in a high tax state, shift even more ordinary dividend flow into sheltered accounts, and remember that foreign stocks held in a taxable account let you claim the foreign tax credit, where the same shares inside of an IRA often lose that credit. So every dollar you send to the IRS is a dollar you don't have to replace with a riskier yield. Now, the second guardrail is inflation, because a portfolio that yields 4% today isn't going to feel like 4% after 20 years of rising grocery and medical costs, unless those payouts grow. And that's why the focus should be on dividend growth names like dividend aristocrats, stalwart consumer staple giants, or even mature tech firms like Microsoft that have raised their checks faster than the consumer price index year after year. And when you mix in real asset plays like pipeline partnerships or infrastructure REITs and regulated utilities, see, their revenues often adjust with inflation or are tied to essential services that people just can't skip. See, some securities actually come with built-in resets. REIT leases that escalate with CPI, or preferred shares that flip from fixed to floating coupons, adding an extra layer of cost of living protection. During the accumulation years, reinvesting every dividend compounds that inflation defense. The new shares that you buy today become tomorrow's bigger payout. Now, the third guardrail is a fallback bucket, a simple liquidity buffer of 1 to 3 years of basic spending needs that are held in safe short-term investments. Think high yield savings and treasury bills for the first year, then maybe a short-term treasury ladder or ultra short bond fund to cover years 2 and 3. And you refill the bucket whenever your stock allocation drifts more than about 10% above target, or when excess dividends pile up. See, if markets crash or a company trims its payout, you can draw from the cash pool instead of selling stocks at a fire sale or chasing dangerous 8% yield just to make the math work. Just knowing that there's money that is parked and ready often provides that psychological edge that keeps investors from panic selling, which is extremely important in down markets. See, together, these guardrails form a coordinated safety system. You've got smart tax placement that keeps more of your income in your pocket today. You've got inflation-aware holdings that keep income's buying power intact for tomorrow. And the liquidity buffer means that you never have to break the other two rules when the markets misbehave. You align all three, and a dividend-focused retirement plan can deliver dependable, rising cash flow for decades without the white-knuckle moments that sink so many yield chasers. And one thing about dividends is that they are not one-size-fits-all. There are really 4 common breeds. See, the quality, reliability, and growth potential of dividend income varies widely depending on the source. So let's break down the 4 most common categories and what makes each one unique. See, the first are the dividend aristocrats. You may have heard of these. These are the elite companies in the S&P 500 that have increased their dividends for 25 consecutive years or more. These are household names like Procter & Gamble, Coca-Cola, McDonald's. They're reliable, they're steady, and widely held by income-focused investors. Now, what sets dividend aristocrats apart is not just their consistency, but their resilience. You see, these businesses that have weathered recessions, market crashes, inflationary periods, and still kept raising their payouts. They often operate in consumer staples or defense sectors, which means that they tend to hold up well in uncertain markets. Now, the yields, they might not be eye-popping, but the combination of stability and growth makes them strong core holdings. And the second category is REITs, or real estate investment trusts. And these own and operate income producing properties. So everything from apartment complexes to shopping malls to data centers. And by law, they must distribute at least 90% of their taxable income to shareholders. This means that REITs often have higher yields than traditional stocks, sometimes topping 5% or even more. But that higher income comes with trade-offs. You see, REITs can be sensitive to interest rate changes and economic slowdowns. And because most of their earnings are paid out, there's less room for reinvestment and long-term dividend growth. Still, REITs can play a valuable role in a portfolio, especially when held in tax-advantaged accounts to offset their less favorable tax treatment. And then there are utilities. See, utilities may not get much attention in the headlines, but they've long been favored for retirees and conservative investors. because these companies, they deliver essential services like electricity, water, natural gas, services that people must have regardless of economic condition. Now, their revenue streams are highly regulated and relatively predictable, which supports steady dividend payments. Now, growth is usually slow, but the risk is usually lower. Utilities can add ballast to a portfolio and help smooth out returns when more volatile sectors take a hit. And the fourth category are dividend-focused ETFs. Because if picking individual stocks just isn't your thing, then dividend-focused ETFs, those offer hands-off approach, and there are funds like the Schwab US Dividend Equity ETF, or the Vanguard High Dividend Yield ETF, or the JP Morgan Premium Income ETF that bundle dozens or even hundreds of dividend-paying companies into a single investment. Now, these funds offer instant diversification, lower volatility, and often lower fees compared to actively managed funds. Now, some focus on high yields while others emphasize dividend growth or quality metrics. And the best part is that they make it easy to access dividend income without the research burden of picking individual stocks yourself. So let's take a look at how this actually works in real life. Let me introduce you to Sam. He's 35 years old. He's a software engineer and he wants to have work optional by 60. So he decides to invest $1,000 per month in a dividend-focused ETF, and let's say that it's historically yielded around 3.5% and returned about 8% annually, including growth. Now, if he sticks with it and reinvests dividends along the way, by age 60, he'd have around 1.1 million. Now you flip the switch, you stop reinvesting and start collecting. That's $38,000 a year in dividend income without touching your principal. And if you can live your lifestyle on that amount, then you're done. You're retired on dividends. This approach works, but it works best when paired with thoughtful planning and accounting for taxes, healthcare, and increasing living costs. See, retiring on dividends isn't for everyone, but for the right person, it could be a powerful combination of peace of mind and financial control. Now, you may be asking yourself, is a dividend-driven retirement really for you? I'm going to run through some scenarios, and if you answer yes to all of these or nod your head yes as I'm going through them, then it might be for you. Do you want to keep your principal intact? Does spending down shares feel like sawing off branches that you feel like you might need later? Would you trade the chase for a 10-bagger stock for steady mailbox money every single quarter with predictability that beats the adrenaline rush? Do market swings make you queasy, but you can stomach them if you know the cash keeps rolling in and growing? Are you patient enough to reinvest for years, letting each new share buy the next instead of grabbing every dividend to spend a day? Do you value sleep at night security more than cocktail party bragging rights about the latest high flyer? So if you nodded through most of that list, then a dividend strategy can serve as your personal pension. If not, you may be happier with a growth-heavy or total return approach. And before we get out of here, let's clear up 3 last-minute worries that still trip people up. And the first is, don't rising interest rates crush dividend stocks? Quality players may dip at the moment of a rate spike, but companies that keep hiking their checks usually bounce back quickly once rates level off, and diversified portfolios include sectors like banks and insurers that benefit from higher rates. That brings us to the second question. If I reinvest every dividend now, aren't I giving up income I could spend? Those reinvested dollars buy extra shares while you're still working, and each new share adds to tomorrow's payout. So effectively, you're prepaying yourself a larger inflation-proof raise for retirement. And third question, won't focusing on income make me miss out on high growth winners? Well, in practice, steady cash generators such as Microsoft or Costco sit inside many dividend ETFs, and long-term data show that total returns from dividend growth companies have matched the broader market with much smoother rides. So can you retire on dividends? Well, the answer is yes, and many people do. See, it's not magic, it's math. It's save consistently, invest intentionally, let time and compounding work for you. So when you stop reinvesting and start collecting those checks, it's pretty satisfying knowing that the money is now working for the life that you want to live, not just the yield that you want to see. So if you're wanting to optimize your retirement income, then go ahead and click on the link in the description below. You can book a free call with me, and I'll show you exactly what you need to do to optimize your plan. Once again, my name is Johnathan Rankin. I hope this video helped you make the most out of your retirement.